Hey everyone, it's Mike from Order Flows here, and welcome back to Order Flows Unlock, the Advanced Trade Setup Encyclopedia. This is the Trade Setups Part 4, which is Trade Setup 61 through 91. All right, now just remember, these setups are not in any particular order. And, sometimes you're going to see that some of the setups do look a little bit familiar. It's because, order flow is fractal in the sense that it repeats itself. There's only so many ways that traders can execute orders in the market, and it does leave a footprint for us to see. So number 61 is extreme delta threshold and resting liquidity. And again, resting liquidity is volume dependent. The extreme delta threshold is explained in the very first module, where I talk about what is, the sort of the different delta nuances. And extreme delta threshold is when delta closes within a certain percentile of the max delta if it is positive delta, or the min delta if it's negative delta. And what is taking place is directional order flow from price and trading through size. So you have aggressive trading dominating, you have major liquidity levels being taken out, and you have aggressive traders taking out big size, basically. So it triggers on the aggressive trading through liquidity levels. And here's an example right here. So you can see your extreme delta threshold, the 328, which is closing within 95% of your max delta of 336. And it's getting through that resting liquidity right here, the 254, the 296, the 488, the 406, the 314. There's heavy liquidity on both sides of this market here. It's taking place on both sides of the bid and the offer over several levels. Okay, here is a bearish example, and the dead giveaway for it is where you're going to start. Is you're going to look for the extreme delta threshold, right? So minus 834 means it's closing within a certain percentile of its min delta, since it's negative delta. So you're going to be comparing it to its min delta of minus 841. That's within 95 percentile. Now the previous bar, right? You also have some extreme delta coming in, minus 134. It's closing on its min delta number of minus 134. So then you got to look for where's the liquidity coming in, resting in the market. And you can see right here, there's the 446, the 407, even down here, you're running into some decent size. 185, 130, 267, 170, 121, 127, 283, 149. I don't have the little arrow on here, but let me just add it on for you. Okay, right there. And people say, well, what about here, this one? If you are looking at resting liquidity, right, you want to be looking at it over over a certain amount of size. And if you're seeing 200, 306, 311, 132, even in here, the 114, 164, this little area towards the bottom of the bar, it's a little light on the liquidity. I like to see this liquidity sort of be consistent taking place in here. But again, even this right here, you can also make that argument that it is getting through resting liquidity, and it does have the extreme delta threshold. The only difference is obviously the extreme delta. It's extreme, but it's a bit light side. But this one is for sure clear and dominant. 834 versus 134. It's a difference, of 700 contracts. All right, number 62 is momentum strength and volume decline. And of course, it's going to be great in trends. Now, again, momentum strength, it doesn't matter how you determine it. And for consistency in this course, I'm just using a simple EMA, 14-period EMA. And volume decline is, the way the order flow is trading in the edge of a bar. So what you have is strong trend with weakening flow in the bar, clear directional momentum, falling participation, potential reversal signal within a bar. This is going to trigger on momentum with the declining volume. So you can see right here, we're trading underneath our moving average. So I know the trend is down. The momentum is down. And here, right, 17, 124, 456. So as you're going up in this bar, the volume is declining. That's why it's called a volume decline. Here, 28, 4, 1, 268, 144, 22. Okay, here's the bullish versions. So again, where are we trading? Where's the momentum? Momentum is bullish to the upside. You see the 233, 68, 1. 410, 205, 2. Number 63 is open point of control and zero print. And it's going to be good for markets that have more zero prints, obviously, like currencies, and not necessarily for ES or MES, just because those markets trade a lot of volume, and volume is distributed pretty well in those markets. So you don't necessarily see a lot of zero prints, although there are going to be times where there are zero prints in those markets, but just be aware of that, okay? And explanation is the key level with no opposition. So your key level is going to be your open point of control. It's a new level, and no opposition at the edge of the bar, which is the result of the zero print. So you're going to have clear price acceptance level at new levels, no counter orders at the edge of the bar. You're going to have direction confirmation, obviously, with the point of control coming in at a new higher level. So it's going to trigger after the open point of control with zero prints. Okay, so here we go. Here's your open point of control. Here's your zero print, the zero. Zero print is going to be on a red candle on the top offer side at either the top two price levels, or on the bullish side, it's going to be on the bottom two bid price levels. So here's the zero coming in at the very bottom level. Here's your open point of control. You can see you got a nice move as a result. Number 64 is accumulation distribution plus thin prints. One, I put in parentheses 1 and stacked thin prints of 2. Again, how you use thin prints and, depending on the market that you're trading, maybe you don't want to use stacked ones, and maybe, if it's a thicker market, maybe you want to use a little bit higher than 1 as a thin print. You could use 3 or something. And again, be careful in normally thin markets, right? If you're trading, markets that are inherently thin, maybe MNQ or something, certain, YM, even certain times of the days where it's normally thin markets, you're going to get a lot of thin prints. So just be aware of that. And the explanation is institutional positioning with poor acceptance. You have position building or distributing. You have weak opposing interest, right? You got that thin print in there. Institutional trading, and then aggressive trading taking place, or vice versa. Triggers when accumulation or distribution shows around thin prints. So here you go, right? Here's your distribution, right? Volume of 26 in the bar, so your heaviest volume. It's coming in on the offer side. Here's your stacked thin prints, 1 and 0. And again, depending on the market that you're trading, maybe you don't want to use the stacked thin print. You just want to have 1 thin print in there, okay? But again, this is a euro currency, which generally is inherently a little bit thinner. So that's why I have 1 and 2. 1 being the volume for the thin print, 2 for being 2 in the bar stacked on top of each other. Here's another example. Here's your accumulation, 158. Look at that. It's heaviest volume in the bar. It's coming in on the bid side. It's way heavier than what you're seeing on the offer side. And obviously, here's your thin prints, 0, 1, 1, 0, 0. Okay, now number 65 is market sweep plus vertical liquidity. And what you have basically is a stop run with aggressive moves, which is a big order hitting the market. And again, don't necessarily think of a market sweep as a stop run. It's basically, the reason I refer to it as a stop run is because usually what's happened is someone's put in a stop in the market and it gets triggered and it runs through the market. No, I'm not talking about a retail stop. I'm talking about a big size order, a big size stop that gets triggered. It turns into a big order and sweeps through the market. But again, market sweep doesn't have to be the result of a stop. It could just be a big trader coming in saying, hey, I need to buy, 100 euro currency. Just buy it. I need to buy 500 E-minis. Just buy it. And what you have is fast price action. You have the market trading through size. It's going to trigger after the sweep generally and with vertical moves. Okay, so here's your sweep coming through, 2, 1, 0. Right, and then you see the vertical liquidity, very strong size being taken out, 344, 262, 410, 537, 389, 372, 253. Again, here's your sweep taking place at the edge of this, at the bottom of this bar. As soon as this bar opened up, sweep comes in and is getting through heavier volume on the way up, right? The 124. Now, again, if vertical liquidity is volume dependent, and depending on the chart that you're trading, you may set it a little bit lower, you may set it a bit higher. And on E-minis, if I was on a 1 minute chart, I would use 200. This is a 30-second chart. It's set a little bit lower at I think 100 in here. here's a euro currency. Okay, it's a 30-second chart. Euro currency, I generally will use about 50 depending on the chart. If it's a very fast chart, I'll go down to 25. So here's your sweep coming in. Here's your vertical liquidity, 50, 87, 82. Okay, so just again, vertical liquidity is the market trading through size that you define as bigger than normal size. Okay. Number 66 is the PLC slingshot plus volume imbalance, and the explanation is price rejection with institutional flow. And what you have is strong PLC rejection, clear institutional participation, aggressive traders are present, and it's going to trigger on the point of control rejection with that imbalance. Now, it's a volume. For me, I have two types of imbalances. There's volume imbalances, stacked imbalances. Volume imbalance is 3 or more imbalances that are spread out through the bar. Now, if you have 3 imbalances that are stacked, if you have a stacked imbalance, it's still going to show up as a volume imbalance. But I just want to show you here is an example. It's the PLC slingshot coming in, right? So you got 2 red bars. The point of control on the second red bar is higher than the first one. Then you've got stacked selling imbalance plus another imbalance in there. So you got 4 imbalances in the bar. Okay, so basically you see a PLC slingshot, look for as many imbalances as you can see. Here's another example. Now this is with volume imbalance of 2. Okay, now people say, why would you use 2 imbalances in a bar? A lot of times bars have 1 imbalance. When I start to see more than 1 imbalance, to me that's something that's important. Okay, so I could accept 2 a lot of times, especially if I'm using a PLC slingshot, right? Because what's taking place on a PLC slingshot is, the market is starting to trade up, right? In the previous bar, it's a green candle, right? Point of control comes in, and then the next bar comes in, and then it starts trading lower, right? For a bullish PLC slingshot. Then it puts in that heavy volume down there. And what I'm looking for now is either acceptance or rejection of this heavy volume, and it's rejecting that heavy volume down here, and the aggressive traders are coming in and leaving the volume imbalances in there. Okay, so again, you could use 2, you could use 3 for your volume imbalance when you're pairing it up with PLC slingshot. All right, number 67 is stacked imbalance plus a delta tail. And what that is it's multiple pressure points with aggressive moves. You have repeated order flow pressure, strong aggressive flow, you have direction confirmation, and it triggers on stacked imbalances with delta tails. Okay, so here you go. You see your delta tail, right? It's coming in actually right here. And again, it is a little bit easier to see delta tails if you're using a delta footprint. But if you're not, then it's just going to be a little bit harder. You got to start recognizing these things. You can just look at the bar, and obviously the heavy volume, well, not say the heavy volume, but the first clue that you could potentially have a delta tail is looking at the bottom of the bar. Okay, do you have the negative delta? If it's a green candle, if it's a red candle, you're going to do the opposite. You're going to look at the top offer side. So you're going to look at the bottom price level of the bar, and if you have more aggressive selling than you had aggressive buying, that's usually that's going to be the first sign of a delta tail taking place. And then you're going to start just eyeballing it. Okay, I got positive delta, positive delta, positive. I mean, I'm doing the math in my head: 0 against 43, 8 against 41, 7 against 40. 4 against 40, 7 against 41, 19 against 36, 14 against 65, 0 to 35, 18 to 24, 2 to 25, 0 to 3. All right, it's just I don't have to actually know the exact number, but I know that the volumes here are greater than the volumes here. Okay, and you got your stacked imbalance. Now, this previous bar here, right? You do have a delta tail as well, right? 18 versus 9. Then 12 against 55, 15, but you have 2 imbalances. Okay, now do you want to take that as a potential signal? 2. Usually when I'm talking stacked imbalances, I'm talking 3, because also over here a little bit earlier you got the similar thing with 2 volume imbalances. Here you have 2 stacked imbalances. It depends. For this setup, it's stacked imbalance plus a delta tail. Now again, the opposite is true for the bearish version, stacked imbalance plus the delta tail. Okay, so positive delta at the top of the red candle, then all negative delta here, 50 against 3, sorry, 25 against 3, 27 against 0, 17 against 0, 7 against 6, 50 against 27. So it's all negative delta at price in this bar. Okay, you see a nice little move down. All right, number 68 is order flow gaps plus volume decline. Now, with this, right, again, you have to be able to discern where there's an order flow gap, so you have to put the value areas on a bar. And what you have is value shifting after weakness, values moving directionally, internal weakness signals, strong move away from weak order flow in a bar, triggers when gaps form after order flow weakness, okay? So here's your gap in the order flow, right, from this bar to this bar. And I can see my volume decline taking place. 30, 18, 6, right? Volume is declining on the way down, just as the bearish version, 9, 11, 14. And here's my gap in value, my order flow gap taking place right in here. Let me just put a little shape on here for you. Right, this is your gap. This is your gap here. Okay, that's your gap. And the weakness is going to be coming in, or sorry, the volume decline is going to be coming in on the first bar of the gap. Okay, the bar that starts the gap. You're looking for that volume decline, because what's taking place is, you know, the market tries to trade up a little bit, or it doesn't even, you know, can't get anywhere. There's the lack of that aggressive buying coming in on this offer side, and then the market just gets slammed, and then it's trading weaker and starts selling off. All right, number 69, delta breakout and resting liquidity. Okay, so again, both are going to be volume dependent. 25 breakout, 25 for the liquidity is a good starting point if you don't know where to start. Sometimes people set these things so high, 200 and 250, that it's too high, you're not going to get any signals, because now you're combining signals, right? So, you know, again, depending on the market, you don't want it too high anyway. The explanation is strong move away from volume. It's clear directional pressure. Aggressive trading is present. High probability continuation in direction of delta breakout. Triggers on the delta breakout around liquidity. Okay, so here's your delta breakout. It goes from 326 to 518 and is getting through your resting liquidity in here. You can see the volumes. Even in this bar, right? You're just looking at the volumes, the 574, 432, 352, 184. Then you're getting in these next bars, 253, 308, 546, 333, 428, 298, 226, 191. Okay, so you have that aggressive selling, right? As you can see in the delta breakout, and it's getting through that liquidity that's sitting there. Here it is on the upside, right? Delta breakout jumps from 200 to 700. 203 to 731. It's getting through this liquidity up in here. You know, it's the 322, right? The 280, 322, 427, 215. Number 70 is market weakness plus volume imbalance. Okay, now I have in parentheses 2 and 2. And, you know, I'll show you with 2 and 2 what that means when I get to the chart. So the explanation is trend weakness with institutional flow. You have internal weakness signals, clear institutional participation, reversal potential in the direction of imbalances. And it's going to trigger on weakness with the strong imbalance. Okay, so 2 and 2, right? So the first one is going to be for the market weakness. Now, it doesn't have to be 2. Generally, I use 3. And as well, the other 2 is for the volume imbalances. So 2 imbalances in the bar, and market weakness is going to compare the delta over several bars, right? But even though I have 2 here, this is actually weakening going into 3. You can see this market is sort of going up here. The delta is strong, 380, then it weakens 299 to 73. Okay, so there's actually 3 right here. So I should change that just so you're not confused. But you could use 2, right, where it's declining over 2 bars, right? And then the aggressive selling comes in. This one is also a version of 3, even though I started with 2, but I wrote 2, but you could use 3. Sorry, you could use 2. The examples I have are using 3. So 238 as it's coming down, 238, 60, negative 67, negative 56, and then you got 2 buying imbalances coming in. So that's your sign. So what you have is aggressive selling is weakening over 3 bars, or 2 if you're going to use 2. And then on the last bar, you have aggressive, in this case, aggressive buying coming in, right? For a sell, it would be aggressive selling coming in. So you have the aggressive selling is weakening, followed by aggressive buying coming in. Just as you have aggressive buying weakening here, 380 to 299 to just 73. But when it gets to this last bar, you have aggressive selling coming in. Okay, number 71, momentum strength plus zero print. And it's going to be better for more liquid markets where not a lot of zero prints appear, or, US hours in, things like currencies. Explanation obviously is a strong trend with no opposition at the bottom of the bar or top of the bar if it's bearish. You have clear directional momentum, no trading at the edge of the bar, strong continuation. Triggers on momentum with the zero prints. Okay, so here we go, right? We're underneath our moving average, so I know momentum is down. Here's your zero print at the top. Okay, here we go. It's your zero print, right? We're trading below, so I know the momentum is to the downside. Here's your zero print, the zero coming in right there. Here's the bullish version. We're trading, momentum is up. You got actually a delta tail. You got 2 zeros in here, 0 and 0 taking place, but still qualifies as a zero print. All right, number 72 is POC wave plus exhaustion print. Explanation is price and volume movement with bar exhaustion. All right, POC wave is a 3-bar pattern. All right, so you have clear volume movement, you have exhaustion signals, and it's a reversal setup taking place there. Okay, it triggers when the POC wave completes with exhaustion. So here's your POC wave, right? Red bar, green bar, green bar. And your exhaustion print's coming in on the 3rd bar, the 2. Here's your POC wave, so green bar, red bar, right? Point of control in the green bar. Point of control on the red bar is higher than the green. Point of control on the third bar, which is the second red bar, is lower than the point of control of the first bar. And your exhaustion print is coming in at the 3rd bar. Another one, right? Red bar, point of control. Then the second bar is a green candle with a lower point of control than the red bar. Then the 3rd bar is a higher point of control than that red bar. And here's your exhaustion print. All right, number 73 is the line point of control plus a delta tail. And the explanation is fair value levels with aggressive moves. You have strong support resistance, strong directional flow, consistent trading appearing, and it triggers when POCs align with delta tails. Okay. So here you go, right? Your aligned point of control, 2 point of controls at the same level, and you have a delta tail, right? So you got the positive delta here of 27, 13 against 40, that leaves 27. Then obviously 148 is greater than 70, 115 to 64, 123 is better than 32, 37 is more than 35, and 9 obviously is 0. So you have a delta tail in this bar, plus you have a aligned point of control. Here's the bullish version, your aligned point of control. Delta tail, 3 versus 2, so you have plus 1. Then 25 against 75, you got positive 50. 11 from 12, you got positive 1. And 1 and 5, you have 4. So 4, 1, 50, and your negative delta of minus 1. All right, 74 is imbalance reversal and thin print. And what this is order flow shift with poor acceptance. You have order flow direction change, you have weak opposing interest, you have reversal confirmation, and it triggers when imbalance reverses with thin prints. Okay, so here you go. Imbalance reversal is this buying imbalance in the red bar, so what we used to refer to as second slot imbalances. Sometimes you see it floating around with other vendors out there that sell software. They have taken my concepts and put it in their own software. They use some of the legacy terms, such as second slot imbalance, but it's what we call an imbalance reversal now. And here's your thin print 1. Okay, whoops. There you go again. The selling imbalance on the green bar at the bottom, 20. And here's your thin prints, 2 and 4. So when you see that imbalance reversal, next thing you should look for is a thin print in the bar. Now, abandoned value area and vertical liquidity. Now, again, you have to have value areas on your chart. And what an abandoned value area is a value area that's not traded into by the next bar. And then, you're going to want to also have the vertical liquidity. So what you have is value rejection with aggressive moves because it's getting through liquidity. So it's clear value area rejection. So you have fast price action and strong directional bias taking place. And it's going to trigger when value abandoned with vertical moves. Okay. So here you go, right? Here's your abandoned value in this bar. I don't have the arrows here. Okay, so I know that, right, I have this abandoned value area here because I know it's not traded in the next bar, and it's getting through some very decent size in this bar that has the abandoned value area, the 317, the 254, the 313. Or vertical liquidity is like stacked heavy volume in a bar. Think of it that way. So again, depending on the market, you're going to adjust your liquidity size. E-minis, good starting point is 250, if you're on a 1 minute chart. Okay. But again, you got to do your own research and figure out what works for you. Okay. Here's vertical liquidity on the way down, the 352, the 339, 601, 252, but it's not an abandoned value area. Okay. You see it right here. Let's see if I could turn this arrow here. It's right here, right? Here's your abandoned value area. Here's your vertical liquidity, right? 425, 446, 225. And again, 250, 200. It's up to you what you want to use for. I think the default on my software is set at 200. Okay. Here is another example, but this is interesting because this is a doji candle, right? Open and close at the same price. That's why it's gray. And generally speaking, when I see a doji candle in the order flow, I sort of just ignore it in the sense of, because it doesn't give me any direction, right? I like to have price action, right? Green candle, red candle, making a decision. Because you could almost make, an argument either way. Is there liquidity in this bar? It's borderline. I mean, obviously 500, 420, 188 if you're looking at the downside, but then you got one 518, or sorry, to the upside here, but on the way down, 518, 532, 148. This is what I talk about. When I see a doji candle in the order flow, it really gives me conflicting signals oftentimes, and I just tend to not necessarily use it in my analysis, okay? But again, it's up to you if you want to use doji candles in your analysis. Me personally, I tend to just wait for more clearer opportunities and price movement. Now, when I say I ignore it, I mean, it doesn't mean that nothing traded, that I could just ignore it. Obviously, volume is trading. But in terms of analysis, I just leave it alone. All right, so delta, number 76, delta divergence and market sweep. Now, you're going to use the swing filter because delta divergence, if you're not using a swing filter, all you have is just a green candle with positive delta. You don't have the price action divergence, right? Or a red candle with negative delta. With the swing filter, you're looking for, a potential reversal taking place. And you could increase the sweep volume to 5. You could also lower the sweep levels from 3 to 2. So the explanation is order flow diverging. The big directional order hits the market. So you have conflicting delta versus price. You have a big order and order flow coming in, and reversal potential, right? Because obviously it's a divergence. Triggers on divergence, then the sweep usually. Okay. So here, again, I don't have that arrow on there. Sorry for that. You know, sometimes I get these charts put up on my screen, and then it's like I thought I put the arrow up and not, so I apologize. So here's your new swing low, positive delta, green candle. So you have a new swing low and positive delta. That is your delta divergence. And then the sweep is coming through the market here, 051, even up here, 301 is the bearish version, right? So you got a swing high coming in here, negative delta, red candle. So you got some aggressive selling coming in, and you see your sweep, 1405. Market's sweeping right through, right? And again, you can use a sweep as low as 2, meaning it's getting through 2 levels. I personally like to try and keep it at 3 whenever possible. But when you're looking at delta divergence, sometimes you don't necessarily get a full sweep, you know, of three or more price levels. All right, so number 77 is accumulation distribution plus exhaustion prints. So the explanation is institutional positioning after exhaustion is present. You have position building or distributing. You have exhaustion signals, reversals underway, and it triggers when accumulation distribution shows after exhaustion. Okay, so here you go, right? Accumulation taking place. Right, it's a green candle, so I'm looking for accumulation. 176, it's your heaviest volume in the bar, and your exhaustion print 4. So when you notice the heavy volume coming in on the bid side of a green candle, look at the bottom of the bar. Do you have an exhaustion print? It's usually a good sign of a potential market move. Just as the bearish example, right? You're going to look at where's the, you know, you start with the distribution. So it's a red candle. So you're going to look at where's the heavy volume coming in the bars, coming in on the bid side or the offer side. Okay, it's coming in on the offer side. So now what I'm going to do is I'm going to look at the top of the bar. Is there an exhaustion print? There is, 6. Okay, that's probably a good trade for me to take. All right, number 78 is stacked imbalance plus volume decline. Now the explanation is multiple aggressive levels after weakening flow. You got consistent aggressive order flow pressure. You have falling market participation. You have potential exhaustion and then a reversal. It's going to trigger on stacked imbalances with declining volume. Okay, so here you go. Stacked buying imbalance with your volume decline, 41, 14, 1. Right? This one's very easy. If you have a stacked imbalance, look, it's a stacked buying imbalance, look at the bottom of the bar. Basically, do you have a volume decline? Just as if you have a stacked selling imbalance, do you have a volume decline in the bar? 11, 61, 69. That's what you want to key in on. Delta breakout plus thin print. So the explanation is a strong move with poor acceptance. You're going to have clear directional aggressive pressure, weak opposing interest, continuation signal, right? It's going to trigger on the delta break and thin prints coming in. Whoops. Got a little ahead of myself there. So here's your delta breakout. You know, this one didn't work out, but I did want to show you, you know, sometimes, you know, this is what I always talk about, you know, take it in context of the market. You got a delta breakout after the end of a move. It might just be capitulation coming in. But here's your delta breakout, jumps from 284 to 1100. You know, and it's got your thin prints, but it's coming in after a move down already. You know, like here you have one here, one up here. Which one's the one you want to take? Obviously, you want to take the one down here. Up here, you've already had a 10-point move. Is there still potential for the move to continue? Of course there is, but at the same time, you know, anytime you can get it coming in near a low, to me is going to be better, or selling near a high. So here's your delta breakout. It goes from 260 to 559. Here's your thin print, the 1 in there. This one jumps from 76 to 342. You got your 1, even your 7 in here. And the market did go up a little bit further. Okay. Here's another example. bearish one as the market's coming down. Again, this is a smaller breakout, but it goes from 1300 to 1400. You got a bunch of zeros in here. It's really, this bar is elongating. It does start to break down, go sideways, then break down some more. Here's another one. All right, you got your delta breakout, jumps from minus 134 to minus 834. And then you can see your thin prints inside, right? The 0 and the 4. Right, 0, 4. All right, number 80. Momentum strength plus market sweep. And you're going to want to use maybe the trade entry signal. Again, I didn't talk much about the trade entry signal. And what that is when the market moves in the next bar, right? So if you're looking for a move to happen, you have your setup take place, but then in the next bar, it has to move in your direction immediately, right? Basically is what the trade entry signal is, but you don't have to. Anytime you're trading with momentum, the market should be moving in that direction anyway. So you're going to have strong trend with big orders, clear directional momentum, basically a stop loss raid completion. Again, with a market sweep, oftentimes it is a stop getting triggered. Nowadays, traders are able to hide their bigger orders, so you don't necessarily get the big sweeps. But, I'll just put here, big order, stop loss raid completion. I even like to use the term raid, but stop loss that was triggered. People sort of have this misconception in their head that people are always gunning for their stops, but stops just get triggered in the everyday trade that takes place in the market. So you have clear directional momentum taking place. Obviously, what I just talked about, big order or stop loss that was triggered being completed, which is your sweep. It's a high probability continuation potential, and it triggers on the momentum after the sweep. So again, momentum, use whatever you want for momentum. In this video, in this order flows unlocked, I do use just a simple EMA. You can use whatever you want. So in my software, I have a more advanced way, but I wanted to keep it simple for you guys. So here, right, we're trading momentum's bullish, and here's your sweep taking place in the bar, right? You can see the 0, the 1, the 0. Okay, this is the bearish version, right? Bearish momentum. Here's your sweep taking place, coming right through this market. 0, 1, 4, 3, 1, 1. It's just a big order going bullying right through the market there. Okay, and here's a bit more, right? You can see the momentum is already, it's to the upside, and you get the sweep, another sweep, another sweep. Okay, so it does make for some nice trading opportunities, right? When you get sweep, but look at where the sweep is coming in, because when you're trading in the side of momentum, oftentimes that sweep is coming in as a result of what? Aggressive trading, right? And if the market is going up, you have that aggressive trading taking place, right? Because the momentum is up. You have aggressive buying taking place if momentum is up. That, to me, that should be a no-brainer. All right, number 81 is order flow gaps and vertical liquidity. And the explanation is, you got market movements with aggressive moves through size, right? It's vertical liquidity, so it's getting through size on the way up or the way down. And you have value area migration, you have fast price action, you have strong directional bias. And it triggers when order flow gaps form with vertical moves. So here's your gap right in here between these two bars, and it's getting through vertical liquidity on the downside, the 199, 160, 151, 136. And again, you got to determine what you're using as vertical liquidity. Now, this is in the E-minis, in the euro currency, and it's coming in at 8 in the morning. In the euro currency, a good starting point is 50. You could even bump it up to 100 for certain times of the day. The U.S. hours, U.S. opening, or the European opening. But, during the rest of the trading session, if you're using 100, you might not get any signals. So bear that in mind. Time of day is also important on liquidity. Here's E-minis on a 30-second chart. Here's your order flow gap between these two bars, the value areas, right? That's what an order flow gap is. It's the gap between the value areas. And here's your vertical liquidity on the upside, the 254, 338, 271, 302. Remember, vertical liquidity, think of it as stacked heavy volume. Okay, here's one to the upside. Didn't really pan out, just went sideways, right? But you can see the liquidity getting taken out, 691, 464, 329. But then it comes right back with a bearish signal after your gap right here. And it took out the bearish volume on the downside, 265, 421, 290, 331, 374, 292, 539, 322. All right, number 82 is volume imbalance. And I have 3 in parentheses with exhaustion prints of 3. So again, what that is 3 imbalances in the bar, either 3 buying imbalances on a green candle or 3 selling imbalances on a red candle, and exhaustion print of 3. Now again, you can adjust that to wherever you want. Say you just want to use 2. Say, it's a thicker market. When I say thicker market, means trades a lot of volume. Maybe you want to have the exhaustion print set higher to 9 or something. Explanation is institutional order flow after exhaustion recognized. Clear institutional participation, exhaustion at the edge of the bar reversal taking place, and it's going to trigger on imbalance with exhaustion print. And again, if, like I said, this is all dependent, right? In this order flow is unlocked, I'm using basically just E-minis 1-minute chart. Sometimes I throw in an 8-range chart as well as Euro currencies, right? With minute chart, 30-second chart, or even a range-based chart. But say I was on a interest rate like bonds or something, or ultra bonds even. I use a 4-range chart for there. So I would use exhaustion print since that market trades a bit more volume. I would use probably 9 and volume imbalance of 2, not 3. Okay, so it depends on the market that you're trading, how you want to adjust volume imbalance as well as exhaustion print. Okay, so here we got multiple imbalances in the bar spread out, 1, 2, 3. The next bar, 1, 2, 3. But you also have the exhaustion print of 2 and 2. So basically, this is easy to see. Do I have multiple buying imbalances in the bar? Yes. Do I have an exhaustion print? Yes. Okay, that's my setup. Just as here, multiple buying imbalances in the bar. Do I have an exhaustion print? Yes, that's my setup. Multiple buying imbalances. Do I have an exhaustion print? Yes, that's my setup. Here, you got multiple imbalances. Do you have an exhaustion print? 6. Again, I have it set at 3, so it doesn't qualify. Here you got multiple imbalances, but you don't have the exhaustion print. What did the market do? Did it go down? Yeah, it did, but it didn't do much of anything else. Okay, it's another example. Okay, 4 buying imbalances with the exhaustion print. 3 buying imbalances, exhaustion print. 3 buying imbalances, exhaustion print. Okay, so you just got to simply look at that stuff. Look for the volume imbalances, and then do I have an exhaustion print? Now number 83 is the imbalance reversal plus 0 print. Now it's not really intended for E-minis or very liquid markets. Good in currencies where 0 prints seem to flourish, they appear more. Explanation is order flow shift with no opposition. You have flow direction change, no counter orders. You have strong reversal signal in your hand. And when I say strong reversal signal, I mean in the bar. You're not looking for this after a big move. Because when I'm looking at order flow, really what I'm looking at is on a bar-by-bar basis. And it's going to trigger when imbalance reverses with the 0 print. Okay. So here you go. Imbalance reversal, 26, and your 0 print right above it. Right? Imbalance reversal is when you have a selling imbalance towards the bottom of a green candle, or a buying imbalance near the top of a red candle. Then when you have a 0 print right next to it, that's your trigger, as opposed to just a pure imbalance reversal. When you take an imbalance reversal, right? And this is what I talk about, sort of in with traders about the tools of order flows traders, is using them together, right? 0 print and imbalance reversal. You just set up your order flows trader to highlight those instances, okay? If that's what you want to look for. All right, so number 84 is open point of control and delta tail. So the explanation is you have your volume migration with the aggressive move in the bar. So you have clear price acceptance at new volume levels. That's your open point of control. Strong directional flow as a result of the delta tail. Price moving together with volume, which is what you like to see in moves. Triggers after the open point of control with the delta tail. Okay, so here we go. Here's your open point of control. And this bar also exhibits a delta tail. So you have your positive delta at the top, offer side of the red candle. Then it's all at price, all negative delta on the way down. Okay, so you have aggressive selling all on the way down. The opposite is true for bullish signals. Okay, so you got your open point of control coming in here. It's just higher than all these previous bars' highs. And you have your negative delta at the bottom of the green candle. And then it's positive delta all on the way back up. Same thing here. The 136 versus 76. That's, what is that? That's a negative 60. And then it's all positive delta at price on the way back up. All right, number 85 is aligned point of control and thin prints. It's especially good when the market's moving quickly. And what it shows is strong price level with poor acceptance. And you often have a strong support resistance level being formed. You have weak opposing interest as market moves. Market moving away quickly from a volume level. And it triggers when POCs align, then thin prints appear. Okay. So here, right, markets go back and forth, right? Then the POCs align, right? It's like planets aligning. And then you got your thin prints in here coming in right before the big move takes place. You got your POCs aligned, and then your thin print 3 in here before the market starts crapping out and selling off. So when you see a line POC, what's the next thing you're going to look for? Thin prints in the bar. Does this bar have thin prints? It does? Okay, that's actionable. Number 86 is open point of control and order flow sequencing and thin prints, right? So now I'm getting into not just 2 things, but 3 things. Okay, it takes it a little step further. Now, there's only a handful of these that are 3, but it's, hopefully by now, since you understand what you're looking at, you're starting to see other things in the order flow. So open point of control, order flow sequencing, and thin prints the explanation is key price levels with order flow patterns and poor opposite acceptance. So you have strong counterflow as price seeks more volume, weak opposing interest, stronger passive traders taken out, triggers when strong order flow and volume appears at new levels. Okay, so open point of control here and here, sequencing 17, 36, 152, 291, 396, and you got thin print in there, 0 up here. Here's same thing. Your thin print is 1, open point of control, sequencing taking place. See 18, 30, 108, 169, 234, 263, 843. So now you have 3 things taking place in the market. Okay. Open point of control, thin print 0, 2, and sequencing coming in here. 3, 8, 9, 34, 39. Okay, number 87 is momentum strength plus stacked imbalance plus 0 print. And it's good for fast moving charts like sub 1 minute. Explanation: strong directional moves confirmed by multiple imbalances and lack of opposition. You have aggressive directional price movement, significant supply and demand imbalance, and potential institutional activity. Complete absence of trading activity at specific price levels. Triggers when there is minimal opposition to the prevailing momentum. Okay, so momentum, obviously, trading below the moving average, stacked selling imbalance, 0 print. Okay, so if you see a stacked selling imbalance, stacked buying imbalance, does the bar have a 0 print? Where are we trading relative to momentum? Stacked buying imbalance, 0 print. Where are we trading relative to momentum? Number 88, momentum strength plus abandoned value area plus volume imbalance. And the explanation is strong moves away from rejected value areas with institutional confirmation. You have clear and aggressive price movement showing strong directional commitment. Previously active trading zone that suddenly loses interest and acceptance. Significant disparity in buying, selling volume, and direction of the move away from value. Triggers when price decisively rejects previously accepted trading zones confirmed by significant volume imbalances. Okay, so you got momentum. Obviously, we're going down. Abandoned value area here. Volume imbalance in the next bar. Volume imbalance in the next bar. Okay. Momentum's to the upside. So you have abandoned value areas coming in on this bar right here. The bar right before you have the volume imbalances coming in. That's how I know that the abandoned value area is coming in, because I got the next bars confirming that the abandoned value area, this one is not, I don't know, I put that there. But here you have the abandoned value. Here is not an abandoned value area, but I think I had that arrow there to show you guys. You got the momentum, you got the multiple imbalances, but you don't have the abandoned value area because it trades into this bar's value area in this bar. Same thing as here, it trades in this value area, even though you have the volume imbalances taking place here. What you want is abandoned value area and the next bar to have the multiple imbalances, and obviously being on the right side of momentum. All right, 89, stacked imbalance, delta breakout, exhaustion prints. Okay, so explanation, it's multiple pressure points leading to breakout and climactic action. You have concentrated institutional interest and building pressure for a potential move. Significant shift in buying and selling pressure showing clear dominance of one side over the other. It's confirming directional bias. You have low volume at extreme prices indicating lack of interest in opposing direction. It triggers when multiple imbalances stack up against and align with a strong delta shift. Okay, so here's your stacked imbalance. Here's your delta breakout. It goes from 8 to 155. And obviously your exhaustion print, 1. Okay. What am I here? Here's your delta breakout. Goes from 90 to 897. Now this one I have stacked imbalance of 2, right? 1, 2, another 2 up here, right? And my exhaustion print of 2 at the bottom of the bar. Now again, stacked imbalance, you could determine, do I want to use 2? Do I want to use 3? You could use 3. You could use 2. Usually when again, it's sort of, traders are sort of, it's pounded into the head that for stacked imbalance they have to use 3. But, you can use whatever you want, right? You could use 2, you could use 3, especially if you're scalping, right? You're looking for quick hits. Right here, if I was scalping, I got delta breakout. I've got 2 stacked selling imbalances of 2, right? And I just traded in that direction. Is it a big move down? No, but it's it's a move I could have, scalped a few ticks here and there for, right? Because again, people, traders, we all love to get those big, massive moves, but a lot of time trading is won in the trenches. All right, getting there. 90, small min-max delta plus extreme delta threshold plus volume imbalance plus exhaustion prints. This is a 4-piece trade setup. Explanation, it captures hidden strength through combination of positive delta reinforced by multiple imbalances and exhaustive signs. Shows consistent aggressive trading, concentrated strong directional trading, aggressive trading. Lack of volume at bar edges indicate lack of interest. That's your exhaustion. And it triggers when there's sustained aggressive trading confirmed with imbalances and lack of opposing trading. Sorry. So here you go. Okay, so small min max. So this is a small min, it's 0. Extreme delta threshold, 67. So it's closing near its max delta of 67. Volume imbalances, you got 3 buying imbalances. And exhaustion print, 2. It's a bearish version. Small mid-max, you got the max is just 1. Extreme delta threshold, minus 63 is close to the minus 64. It's within 95%. You got volume imbalances, you got 1, 2, 3. and you got your exhaustion print of 1. Okay, here's 1 on the way up, and here's 1 back on the way down. Okay, so min delta -1. Extreme delta threshold, 87, closing near its max delta of 88. 4 buying imbalances, and your exhaustion print, 1. It trades all the way up, and you get the bearish signal. Small min max, it's got the small max of 0. Extreme delta threshold, -276. Right? It's closing on its min delta, -276. 1, 2, 3, 4, 5, 6 selling imbalances. Right? And then you've got the exhaustion print of 7 up there. All right, number 91, open point of control, stacked imbalance, and exhaustion print. Again, you see a lot of exhaustion prints because exhaustion prints is something I spent a lot of years trading with. Open point of control is your key level with multiple pressure points leading to a move. Multiple pressure points is your stacked imbalance. So you have bar volume migrating directionally. Strong directional aggressive trading suggests shifts in positioning. Reversal signs through lack of trading at the edge of the bar, which is your exhaustion print. So it triggers when market test level fails and reverses. Okay, so here you go, open point of control. You got your stacked imbalance in the bar and your exhaustion print of 3. Another open point of control, stacked buying imbalance, your exhaustion print of 1. Bearish version, open point of control, stacked imbalance. You even got 3 and then another 2 down here, and your exhaustion print of 7 up here near the top. Okay, so anytime you see an open point of control, start looking, are there exhaustion prints and is there stacked imbalance? Right, because you want to wrap other pieces of order flow around any sort of clue in the order flow taking place. All right, so this ends the trade setups part 4, and this is the end of the order flows unlocked. So by now you should be able to see the importance of using different aspects of order flow together to better understand what's happening in the market, and more importantly, to trade the market with that knowledge. So when you see, for example, an exhaustion print, what else should you look for that complements it, right? An open point of control, a stacked imbalance. The market is just a puzzle, and once you start putting the pieces together, everything just starts to make sense. And hopefully, really, the whole point of this isn't just to give you trade setups and go on your own and do it. You're going to go through this, and you're going to realize, hey, you know what? Open point of control is something I could see easily. Okay, let me just go look at what are the setups I could look for. Okay, open point of control. Exhaustion print. Open point of control and exhaustion print is good. What if I have a stacked imbalance? What if I have a volume imbalance in there? Things like that. That's really what I want to get you to start thinking, and maybe craft your own trade setup as well. Okay, because really there's so many different aspects of order flow, so many different little nuances that, you know, this is just, I don't want to say scratching the surface, but, you know, this is a starting point for you on your journey as a trader. So again, thanks everyone for your time and your support with the Order Flows Unlocked. Hopefully, you know, you are going to become a better trader. That's the whole point of trading, doing courses, modules like this is to become a better trader. So thanks everyone. Take care. Bye-bye.